Welcome to Bar Charts Market and Close. I'm your host, John Rowland, Bar Chart Senior Market Strategist. And today's show is about the three V's: valuation, volatility, and variance. So we've got a really jam-packed show today, so I want to get right to it. So let me introduce and bring aboard to help me out with today's show is my co-host, Mr. X, Thomas. Hello, Thomas.
Hello, John. How's it going?
I'm worn and ready to go after our short little hiatus last week.
Yep, we got a jam-packed show, as you said, John, so I don't want to take up too much time here. Just a quick reminder for those of you watching on our website, if you want to ask a question, just click Ask a Question at the top right. You'll see it in the orange color. If you're watching on YouTube, just go ahead and ask those questions directly in the chat. We're going to get to as many of those as possible. All right, John, so there's no denying that U.S. stocks are starting to get a little bit expensive. In fact, John, I just saw this rather alarming post from Bank of America. And it basically says that they've been tracking certain signals in the market, John. 60% of them have triggered as potential warning signals. Now, you might think 60%, oh, that's not too bad. Well, the problem is that in the past, when the 70% number gets triggered, a stock market peak soon follows. John, do you think that this is a potential problem for the U.S. stock market? And if so, does it make sense to maybe start looking outside of our borders, potentially at, maybe Europe or Asia? What do you think?
Yeah, I think, I don't think it really matters what metric you look at. It valuations are high across the board. I mean, but again, doomsdayers have been kind of saying this for a while. I mean, there's all these different ones. I remember we did a show on the Hindenburg omen, but one of the ones that I saw that was kind of interesting, and I think this is kind of to your point, is that the PE ratio discount of the S&P to, let's say, global indexes is at a 20-year divergence, or for instance, like the S&P forward is 20 times forward, and the global indexes are around 13. And if we look at that in a statistical probability, that is at a 2 standard deviation, something we haven't seen in 20 years. So yeah, definitely world markets are undervalued. And if you go to and again, this comes to your point, if we go to like the world indexes and we look at them through the lens of what's happened so far the year, the S&P is up about 4%, give or take. And we can see that, I'm going to rank these by year to date here. There are many world indexes that are doing a lot better than the S&P. So maybe investors are starting to think about this. I know that a lot of folks are thinking about maybe looking into Europe because there might be a positive outcome on the conflict in Ukraine. But there's certainly a lot of other unknowns that could happen, right? We don't know what's going to happen with tariffs, good or bad. But if you look at them in terms of the ratio of PEs, US versus, let's say the stocks, the Euro 50 stocks, right? Again, that's like something 22 to 14, but you could see the euro is up almost 12%, 14% so far this year. So I think that from an investor's standpoint, and we have a lot of gains that have been made in the U.S. market. It just makes sense to do some, reallocation or some diversification into some of these other indexes. Now, do I think that going into Europe is the way to go? I don't know. I mean, yeah, they're undervalued versus U.S. markets, but here's the stock 600. This is kind of equivalent to our S&P 500. You're still at all-time highs. These are still at all-time highs. So I think there is an opportunity, and I think there is some potential, and I certainly think the timing is right for some diversification. But I think there is some better opportunities, let's say, away from European markets and maybe somewhere else. So let's look at that. So here is, here's the top countries by gross national product. And, we got US, China, Germany, European, right? And then you get Japan, right? I think folks have kind of forgotten about Japan. There's a lot of things that have been going on in Japan recently. The Bank of Japan has stopped that yield control, curve control program. They're starting to raise rates. Their GDP is actually, if you look at their GDP, for decades, it was kind of just flat, going nowhere. It's actually been on the rise. And there's projections that it could jump above 2% this year. So I think there is potential growth and opportunity in the Japanese market, because I just feel like that folks have forgotten about Japan. And you think about Japan economy, right? It is a tech economy, right? And that seems like tech is the answer recently. So kind of my idea, or what I've been thinking about doing, and in full disclosure, I have started to build a position in, is I've looked at a lot of different Japanese ETFs. And the one that I kind of like here is this EWJV. This is the value one. And again, let's look, if we go back to the euro, right? We're making all-time highs here. And again, momentum is your friend, trend's your friend. So, but if I look at, let's see, the Japanese market here, it feels like to me that this downtrending channel, or this little sideways action that we've had, we're kind of breaking out of it. Now, we did pop above it, and then we're back into the range here. But what I like the fact is the red line representing the 20-day moving average is quickly recaptured not only the 50, 100, and 200 day, but we're back above that 50-day moving average, is the blue line. So I think this is a low risk trade in terms of somewheres to buy in between here and, let's say, the 200-day, and risk maybe the 50-day, or I wait here and wait for the market to break out from this upside, somewheres above this $33.45. So your downside risk here is about $1 or so, where I think the upside potential on this one, if we do some Fibonacci's extensions, or we just kind of think about a growth story in Japan, I think we could easily see something like $37. But my target over, let's say, the next 12 to 18 months is somewhere around $44, $43.90. So that would be a nice return. Now, if you're interested about this particular, again, this is not financial advice. I want you guys to do your own work. And I'm just telling you, just giving you an insight into my own ideas here. So one of the things I like about this one, first of all, is that we talk about that PE ratio, right? Well, this one only has a 9x. And the other thing I like about this one is, you're going to get almost a 4% dividend on this one. And what I really like about this one, Thomas, is that the beta, the relationship it has to the S&P, is 0.65. It means it has a very low correlation to the S&P. So if the S&P does have a correction, or it does trade sideways for quite some time, which we were kind of thinking, we've been thinking that would happen, or even if the S&P has a big correction, I think this ETF is going to be buffered from whatever happens here in the States. And certainly in terms of that value relationship, this is probably one of those ones that has been undervalued for quite some time, and I think has potential to the upside. Just one more note here. If you're interested in this one, you can go to the website, iShare websites. But again, the components in this one, the top 10. So here's some of the companies in the top 10. Toyota, Mitsubishi, not only Mitsubishi, but you get all parts of Mitsubishi, the communication, industrial, and financial, Nintendo, Mitsui, and Honda. And, one of the things we talked about in terms of AI is this kind of this ripple effect. And we talked about software and AI agents and software as a service, but the other part is robotics, machine learning. And Japan is definitely on the forefront of robotics, at least for the last 10 years. And Honda, it's more than just a car company. It's an engine company, but it's also one of the world leaders in robotics. So again, I get a really nice basket of good companies, which I think are undervalued, and it could be a good time for some diversification.
Yeah, I like that idea a lot, John. And you mentioned that people were kind of forgetting about Japan. It was in the news all the time, John, about 6 months, maybe 6 to 12 months ago, that Warren Buffett was buying Japanese equities. And that seems to have been sort of forgotten. Nobody's really talking about that anymore. But Warren Buffett never sold his position. He's still locked and loaded on the Japanese market. So yeah, I think it still has potential, and I like the ETF idea a lot, John.
Yeah, you get a nice little basket, plus you get a nice dividend, and I really like that fact that you have a very low beta. So, whatever happens here, whatever volatility happens here, you're not going to be affected. It's kind of sheltered, right? This is, so which I think is a nice piece that I need to put into my portfolio.
All right. Very good. So, John, let's come back to the States. All right. So, we've already identified, we've talked about maybe the broader markets being expensive. One stock that just didn't care at all how expensive things were getting, John, is Meta. And I cover this every day. People were getting sick of it, John. They said, well, will you please stop talking about Meta? Well, I had to keep talking about it because it was making history. So Meta traded green, close to close candles. So the closing price on one day to the next day, 20 straight green days, John. That is the longest winning streak in history for any Magnificent Seven stock. It was a sight to behold, John. There were a couple days where I looked at it towards the end of the day and it was red. I'm like, okay, the streak is going to end today. And it miraculously recovered and finished green at the end of the day. So, John, what the heck was going on here? I don't think you've seen anything like this before. I don't think I've seen anything like this before. Explain to us what exactly happened, and have we entered a potential danger zone for Meta?
Well, I mean, I don't know exactly what happened or what was the catalyst that kind of set this in motion, but there are some clues that I see in these kind of, when you see a market that is just one way, and not only one way, but it's not really making a lot of large body candles, it's making a lot of small body candles. That's a really good clue that is probably algorithmic program trading. Now, the algorithms, like there's all different kinds of algorithms, but they're basically, what they try to do is they try to find the path of least resistance, and then whatever input that drives them, or whatever data point that is driving them, what happens is you have certain sets of algorithms that are getting some kind of data, and that might drive the market higher, and then that sets off another set of data that drives another set of algorithms, and then that sets off another set of algorithms, and it kind of like this positive feedback loop, almost kind of like a self-fulfilling prophecy. But what also happens with algorithmic trading is that at some point they do reach a point of resistance, or somewhere the market kind of pushes back, and then what we normally see is that's when price can reverse, or this building on top of each other, these algorithms building on top of each other, kind of creates a house of cards. Not that Meta is a house of cards, but the price is a house of cards. And so that when that house of cards collapses, price returns very quickly in the opposite direction. Now, normally what it does is it falls back to an area where we could find the origin of this, what created this price movement, the original data point that could have caused that. And so how do you can identify, and then we'll look at Meta and see where we might think it might go back to. So there are two variables that you can look at. And one is shrinking volume, and that is a very good sign, especially when you're making new all-time highs. And you can just see here, I've added this to our chart. So first of all, this is Meta. And what we have here is in the blue shade area is the Bollinger Bands. Again, I kind of like looking at Bollinger Bands. Kind of gives me this playing field of probability. But you can see that here's a catalyst. There was some kind of catalyst here, right? And that was followed by volume. That was really where we kind of got this thing started. And there was another day in here. Looks like we had a bit of a volume day right there. But from this point on, volume dropped off as we were kind of creeping along. And this, to me, is just algorithmic trading. Now, the other variable that you can look at is something called the average true range. And this is, again, another measurement of volatility. So if you are in an uptrend and you are making all-time highs, you should see a lot of enthusiasm or sentiment. And so in candlesticks, sentiment is expressed by large body candles. And if you see small body candles, that really tells you there's not a lot of enthusiasm in it. And another way you can see that is shrinking average true range. Now, average true range doesn't necessarily mean you're going to go in a certain direction. It just means what is the range for that stock or that futures contract for that particular day. So you have shrinking volume and shrinking ATR. This is a clear sign to me that you have algorithmic buying. Now, where can we go back to? Well, you can see that we've had this kind of quick collapse in the price. 20 days up, you said, was a historical event. Well, look, we're in 4 days here. We're almost taking it almost all of it back. So where is it going to fall? Well, typically in Bollinger Bands, you can look for the mean is the first mean reversion. The second part, again, let's look to see where, there was at least some action right here, but the origin of what started this whole rally. And so that falls in line with other technical analysis. Here you can see, which is the lower Bollinger Band and the 50-day moving average. So I think what you saw here is algorithms push the price up. Eventually something happened. I don't know what happened that set them off, that the tables got turned. Now the price is going to fall back until it reaches where we're going to find real willing buyers. And I think that will be closer to the 50-day moving average, or whatever this event was, whatever the database that created that initial movement that got the algorithms going.
Yeah, and John, I think on our last show, you made a really good observation on Meta, which was the fact that on the weekly chart, it had become the most extended in history using the Bollinger Bands. And it's basically from when you identify that, John, it's basically dropped to that level. So that was a really good thought and call there.
Yeah, and again, look at where, if we look at it on the weekly level, look where the mean is at the week level, falls right in line with that purple line, which is where our 50-day moving average is, which is the lower band of the daily. And again, if you look at this green candle, that is the origin of this last 20-day move.
All right, so let's move from one high flying stock to another, John, and we're probably going to get some groans from people. They're like, "Oh, you guys are talking about this stock again." Well, it's been in the news, so we gotta keep covering it when the price action dictates. Okay, but John, this stock is of course Palantir. So Palantir has been on an incredible run, John, just exploding day after day after day. But unfortunately, John, when you hold a stock that is a high flyer, a high beta stock, any sort of negative news, John, can just crush the stock price. And we've seen that this week. So what precipitated this decline? It's rumored that the Pentagon, John, may reduce its budget. And that, of course, would hurt Palantir because Palantir provides software to large enterprises, particularly in the U.S. intelligence community, John. So that is causing the price to become depressed. Now, when I tweeted this, John, what really caught my attention was that huge gap that you have a red circle around, John. So the question for you is, are we looking at a potential downward move into the 80s?
Yeah, I think so. I think, how I love gaps and I love gap theory. I really do believe in a lot of gap theory. Yeah, and I like to find corroborating evidence. And first of all, I can see that this gap fill will put us back down again, the blue line here representing the 50-day moving average. So again, that confluence of evidence is telling me that there's a probably high probability that we're going to go back to that. And I think if we do a mean reversion in terms of Bollinger Bands, let's do this. I think that will be, yeah, we're right on the mean right now. Yeah, we're not near the bottom of the band. So that'd be interesting to see what happens there. So again, in gap theory, though, Thomas, right, this is not just an isolated gap. Let's look at this in terms of over, let's say, the last year. And like you said, the market has been just ripping, right? So, there are a sequentiality or sequence to gaps. And so usually you get some kind of a reversal gap, and then you get what is called a breakout gap. And then the market runs for a while, it starts trending, and then you get what is called a runaway gap. And then runaway gaps, multiple, you could have multiple, could lead to or become what was called exhaustion gaps. And so, this one could be in an exhaustion gap, which makes me fearful of buying this dip if we do get this dip to the 50-day moving average. Because if you think about it, again, let's go back to a little bit lower time frame here. We have a gap, a small gap. Now, we just come back today and we did touch tails, which is a partial fill, which is usually a good sign. But we are lower there. So that's really telling me that we're probably going to go back down. Now, if we gap below here and then into here, then we're going to have what is called an island reversal gap, which is even more ominous to this particular stock. Now, I don't want to spend a lot of time on this one, Thomas, but we've talked about this one multiple times. I just don't like this stock for a lot of reasons. And one of them is because the PE ratio is just crazy off the board. I mean, if you look at this 933, I mean, they're basically pricing in that they're going to make in earnings next year about $4.5 billion. Now, they only made $2.8 billion in revenue last year. And we're talking about earnings, and they would have to make almost $90 billion in earnings to justify this valuation. So I just don't like this company altogether. I don't care how much government spending they have. I just feel like this is one of those stocks that, like you said, is a high flyer and that is due for some huge volatility.
All right, John. So you're in the bear camp. You hate Palantir, but I got a surprise for you, John.
Okay.
I got a second chance for you, John. Okay.
All right.
I got a second chance for people out there who missed the Palantir run up. Now, oftentimes, John, when you hear people say, "Oh, what's the next Nvidia? What's the next Palantir? What's the next Apple?" Oftentimes the answer is just to buy those stocks because they're going to have a continued growth spurt in the future. But John, let me present to you another idea. And this stock is called InnoData. Okay. And the ticker is INOD. Now, I had never heard of this stock before, John. But of course, we have a fantastic editorial team. We've got a ton of fantastic articles that are being put up every day. And I saw an article that got put up just very recently, John, which is covering InnoData. And it says that Wedbush, in particular analyst Dan Ives. Now, Dan Ives is a perma bull. He's very into technology stocks, John. Now, he's typically talking about, mega cap tech stocks. So this one kind of is interesting that he focused on this one. But he says that InnoData could become the next Palantir.
Yeah, he was one of the first ones that recognized Palantir too, wasn't he?
Absolutely. Yeah, he's been on the Palantir train for quite a while.
Yeah.
So it's really interesting that he pointed this one out. Now, the market cap of InnoData is a lot lower than Palantir. I think it's only about $2 billion. Now, InnoData just had their earnings, John. We were talking about this yesterday in a call. The expected move, I think, was what, 30 or 40%?
I think it was 40%. Yeah.
40%. And it's up 14%. So I was a bit nervous talking about this one today, John. I didn't know which way that was going to go, but the market likes what the company was saying. So up we go again. What do you think?
So what was it up? Oh, I did do a little analysis on this one. But let's go and clear this. Let's clear this chart a little bit. So it did pop today, like you said, a little bit. So yeah, it looks. I mean, I did a little screening on this one. So there is some exuberance run onto this one. And gosh, you know what? Talk about value, Thomas. It only has a forward P of 138, which is, gosh, that's almost like a mega discount compared to Palantir. year.
I mean, that's right in your wheelhouse, John.
So be careful on this one. But yeah, I mean, again, money's got to flow someplace. And here is the new flavor of the day, it looks like, right?
Yeah, I mean, this is going to be a fun one, John. We'll come back maybe in a few months or a bit later, and we'll provide an update on what happened with InnoData. And I'm kind of excited to track it. I don't have an investment in it yet, but I'm excited to track it.
Maybe not investing, but maybe this is a tradable, right? Start looking at some options, probably some high volatility here. Could do some kind of some credit stuff, right?
Okay, so John, let's talk about this idea of passive versus active investing. Now, we at Bar Chart, right? Our mission is to educate. Our mission is to provide the data, the tools, the information that people need to succeed when trading in the financial markets or investing, whatever your flavor is. So we want to help people. We know there's a lot of people out there who want to choose their own stocks. We want to help them. But there's always been this debate, John, about what is better for people, and that is passive or active investing. Now, you had sort of an interesting observation that perhaps in the coming months or coming years, it might become a stock picker's market. So people who are out there with a bar chart account and they're using our tools, they might have an edge in the market, John. What do you think about that?
Yeah, I think so. I think you have a stat here. Let's put that up.
Yeah. So, for the first time, now this is from last year, but for the first time, John, in 30 plus years, passive investing funds overtook active investing funds in terms of assets under management. So that means that people are allocating more of their capital to funds that specialize in passive investing. So it seems like that's becoming the flavor du jour for most people.
Right. I'm not saying folks are lazy. I think they're just finding that it's a lot easier. And I think to your point and to our discussion is that over the long run or over, let's say, a statistical period, that passive investing, and again, when we're talking about passive investing, just folks understand is we're talking about, these indexed funds, right? Not only the S&P, the SPYs or the Qs, but any one of these individual sectors, that they tend to outperform those who are actively in the market. But my thought was, if you look at, where do I want to go here? I want to go to seasonality, right? That's what I want to go to, right? Let's go to
yeah.
S&P.
So if you put in SPY, John, and then
let's do that.
Yeah.
And this, hang on, there we go. All right, so this is kind of to your point about passive investing. If we look over here to the left-hand side, what is the year return? Again, look at this, 28, 26, 28, 31%, right? I mean, for somebody who has no knowledge about the stock market and you put your money in the S&P, well, you did pretty darn good for the last 5 or 6 or 7 years, right? So I understand that, and I agree with that. That for somebody who doesn't have the time or the effort or wants to put in that work to find, the Palantirs and the InnoDatas of the world, passive investing is very profitable. But the point that I said to you is that we're looking at a very biased data here. We're looking at a very short period of time, and that, the result has done well recently. But if we look at, let's say, the returns of the S&P. Now, this chart is the historical returns, annual returns, and this is from our friends at Macro Trends. You can see that, there's been 7 days or 7 years in the last 20 years where we've been above 20%. And if you look over history, that's about normal. About 7 years over 20 years, you're going to get a plus 20% return. But the mean or the average is usually somewhere closer to, let's say, 12 or 15%. Still, for a passive investor, that's pretty good. But there are moments of time where you have, again, about every third to fifth year, you do get a little bit of what we would call negative results. And my point here, Thomas, is that what is happening is there's a change in the market right now. And you can see that, for the 720 plus events has happened in 4 of the last 5 years. So I think there's a more statistical probability that we're going to go to a more normal return, or that we might have a negative year. And so here's my thought. So this is what is called the CBOE correlation index, and the correlation index, it really just kind of reflects the change between the relative premium between the S&P indexes options and the individual single stock options. And the options share is called volatility dispersion. In other words, it tells you if options are more expensive or cheap as they relate to the indexes versus the single stocks or the components that are in those indexes. So the market has rewarded the passive investor because the volatility has favored them. But now we're having what is called a low volatility or low correlation event. And what typically happens is, this is all for options, but for us as investors, what this usually means is that the results of the market, the indexes, are going to underperform those of, let's say, individual stocks, or their volatility is greater. So I just want to kind of show you this, and this is kind of interesting. This is kind of like the VIX, and you can use this as kind of like maybe a contrarian tool. And I'm not predicting a crash. I wanted everybody to understand this. What I'm just saying is that this is another one of those metrics that we're looking at. It's kind of telling us something. And you can see that when we get historically low on the correlation index, that it's usually a topping action in the S&P. Here's another low right here, right? Again, it's not a timing thing, but you can see that here's another low that came to a top. Here's another low that came to a top. And, we're not at an all-time low, but we're certainly flat. And so what I think is the next 18 months, 2 years, I think it's active investing is going to do a lot better than passive investing, because in order for us to get a higher correlation index, in other words, for the index to get back in line, the stocks and the indexes to come back together, usually that happens when the stock market goes down, and then you get that high correlation, and then the market gets back to normal. So this is kind of my caveat to my folks that are out here watching in terms of volatility. But again, I think if we had this discussion over and over, I would definitely lean towards, on the long run, trading these passive indexes is probably the best way to go. But if just a little bit of effort, I think you can do better, especially in this time period. And that's kind of what my point is.
And of course, everybody who comes to market on close and has a bar chart account, John, they have set themselves up for success. They have the information, they have the tools. They are going to beat the market, John, as long as they keep coming to MOC.
Well, we'll try. We're trying our best, Thomas. We're trying our best.
All right, John. So let's end on a fun note.
Okay.
This was a story that I think came out earlier this week.
Yeah.
So there's this new Department of Government Efficiency known as DOGE. Okay, so I want to be clear. I'm not talking about Dogecoin. I'm talking about DOGE, the government agency. So they've been making cuts, John. They hope to save a lot of money in the coming years. And Elon Musk wants to reward Americans. So he wants to send every single one of us, John, $5,000 using their savings. So I'm pumped about that because, John, historically, Christmas is on December 25th, but it seems like it might come a bit earlier this year. So here's my question for you, John. How are you going to spend your $5,000?
Well, if you know me, Thomas, if I woke up tomorrow and there was a $5,000 check in my mailbox, as soon as I took it out of the mailbox, it would end up in my wife's hand. So I'm not spending that $5,000. I'll tell you, when it comes to $36 trillion in debt, You know what? I think better off they keep it and let's pay off that debt. Because if we could get the government out of the debt market where only capital could chase debt, well, we would have like a 2% interest rate, and the stock market would be, the S&P would be 10,000. So I would give up the 5,000 to do that instead.
Yeah, we got a comment from Charlie. He says that this is going to be inflationary. Yeah, we're not going to cover that today. That's a whole lengthy conversation, John, which we can do in the future.
Yeah, exactly.
But anyways, I'm happy for your wife, John. She's going to be $5,000 or $10,000 richer.
I don't know. We filed together, so I don't know. Maybe we only get one. All right, bro. Let's get some questions.
That was a jam-packed show, John. I'm exhausted, but are you ready for some Q&A?
Yes, I am.
All right. So first question, John. You've said you're bullish on Nat Gas before. Nat Gas has had a big move. So the question is, are you still bullish on Nat Gas, or do you feel like the move that it's had that's it? That's the move.
Yeah, it had a really nice move. I mean, gosh, we had like $1 move on a 30% move on natural gas. So, just off the top of my head, I really think that in the short term, it's probably a little frothy. And we probably have reached a short-term high. I do think, though, we're probably going to settle in this range here, somewhere between, let's say, $4 or maybe like the 380-ish area and around 450 on this top side. So I wouldn't be surprised over the next 3 to 6 months we kind of settle in that range. So short term, I think we kind of got the gains that I was anticipating. Long term, I'm very, very bullish on the market. Matter of fact, I don't think we have enough time today. I have recommended some natural gas stocks, and there's one that I'm particularly fond of. So maybe we'll do that another time. But yeah, I'm still bullish on natural gas. But if you're going to play this through, let's say, the ETF or through the BOIL, the leverage ETF, yeah, I think you need to be a little cautious here. We're running out of winter, which is one of the catalysts. Now, traders are starting to focus a lot more on the end of the year storage, and we got to watch what happens. Again, we want to watch what happens with the European energy. Again, if some resolution comes out of potential peace talks, let's keep an eye on the TTF. And which one is the most active one? Oh, we can do either one. And let's look at the chart here. So this one has actually backed off as well. So that would tell me that, I just need to be a little bit patient on this one. So we'll keep an eye on those two elements that would drive natural gas price further, because we're really running out of winter, right?
John, earlier you mentioned the Hindenburg omen. So I think maybe a new viewer was curious what the Hindenburg
omen.
Oh
gosh, I forget what it is. It's something about if it's a number of companies that make new highs and make new lows. So let's go and see if we can see that. There's like 4 criterias on them.
The main point about the Hindenburg omen is it's an indicator that is designed, John, to gauge whether a stock market crash may be forthcoming.
Right. It's based on how many new highs and how many new lows you're making as you're making an all-time high. And so I don't remember what the value was or the statistical value, but I will tell you right here, looking at the NASDAQ, we're just inside of percentage points of all-time highs, or we are at all-time highs. The fact that you're making more new 52-week lows and less 52-week highs, that is one of the criteria in the Hindenburg omen. So I apologize. I don't follow that one. I don't really remember. I just remember it's some kind of distribution between how many new highs and new lows are made in a certain period of time. It's based on a percentage, but here you can see we're getting 2-to-1 more 52-week lows versus 52-week highs. That is not a good sign. And the other thing I noticed, Thomas, and I don't want to spend a lot of time, so get me another question here, but right, look at we're just at the 50-50 mark on a number of stocks that are at the 50-day moving average. You think of being at all-time highs, would be a lot higher than that. So that's
and as stocks have continued to go higher and make new all-time highs, the market breadth is deteriorating, John, and that is known, my friend, as bearish divergence, right?
Yes.
For those of you interested in more on Hindenburg Omen, you can go to our YouTube channel, John, because remember, you did a very short 10 to 15 minute segment, which we clipped out and we put that up on the YouTube channel. So if you just search for Hindenburg Omen on our YouTube, you'll be able to learn more about
that. Good job, brother.
Yeah. All right, John, here's a question for you, a great one. Are you bullish on China?
Yeah, I mean, you know this answer, right? I mean, I'm not a big fan of China because I just don't trust the statistics and the accounting. But I did mention in one of our production meetings of a few weeks ago, and you'll have to testify to this, right? I did say thought that I was very bullish on China, and boy, but I also did say I would be just looking at what I would consider the big four, big three, Bubba, JD, and Pindu. But boy, yeah, look at it. Now, do I think it's going to continue to go? In terms, I've already did this analysis in terms of projection. So we're getting very close to where I would think there would be a topping for Baba. So that could be somewheres in that the high for, in other words, the world indexes. But look, again, we did this analysis here. We looked over, let's say, performance of, year to date. Well, look at it's the Hang Seng is right. Here's a funny little fact though. The number one performing index is the Russian index. So what does that tell you?
That's interesting. All right, John, is now a good time to invest in gold?
Well, I think it's always good. It's not a bad time or a good time to invest in gold. I just think gold needs to be part of your portfolio. Again, another market that we've identified where we thought we got to one of our targets, and it probably needs to rest or relax or gather energy. So yeah, we looked at this before, and we were talking about this 265, 270 area, and we're right there. So I think in terms of short term, probably the market's probably going to trade a little sideways, although the dollar's gotten weaker, which is good for gold. There's a lot of weirdness going on in the gold markets. Gold's flowing into the U.S. because there's some kind of an issue with COMEX inventory. So I don't know what's going on with that. But, if we do have a correction, which we can kind of ominously saying that there's a lot of signals, this is one of those indexes, one of those commodities that would have a higher correlation to the downside. In other words, if the stock market pulls back, I wouldn't be surprised that gold would pull back as well. So, again, it's about patience on this one, or you wait for some kind of a breakout. So again, we're pretty far from our 20-day and we're pretty far from our 50. So, maybe a pull back into the low to mid 260s on the GLD, maybe the high 258 area. That would probably entice me to buy it, or we'd wait for an explosive move to the upside.
We talk about this concept of buying the dip, John, in stocks that you like. I've been a proponent of that for a long time now, and I'm a believer in gold. So when I see fear in the gold market, John, when people say it's over, when it has these big drops, I use those opportunities to go in there and scoop up a little bit more and keep building my position.
Awesome.
All right, so your friend and bar chart contributor Jim Van Meerten, John, he makes this point. He says that even passive ETFs are actively managed because when a stock price rises, so does its market cap. So then we overweight rising stocks, we underrate falling stocks as we quarterly rebalance.
Very valid point. Very valid point. So, but you're paying as a passive investor, you're paying a fee for that active investing, right?
And then I guess it's the degree of which the degree to which an ETF is passive versus active, and a quarterly rebalance certainly would probably fall more in the passive camp than an
But
active.
you had a funny stat for me. I know in one of our production meetings we were talking about, if you look at the money that hedge funds have made over the last 20 years or something, it's like X trillion dollars or something like that. And then you had a funny anecdote to that. What was that?
Since 1969. Hedge funds have made $3.7 trillion, John, and almost half of that has come from fees, which is it's just nuts, man. That's what a racket that is, huh?
Yeah.
Let's see what we got. I'm scrolling through the questions. All right, so we did net gas. John, do you think we will see another new all-time high in either the Qs or the SPY this year?
Yeah, I think so. I think, again, my scenario for this year was I thought the market would trade sideways for the first half of the year until we kind of digest the new administration, what, all the things that were threatened or said that were going to happen. And then, we talked about treasuries. The Treasury has to rebalance or refinance a lot of debt. So I thought that was going to be a tailwind for the equities markets. But I do believe that, come, let's say, late September or October, when we get through that seasonal downtrend time, that I think the market will finish stronger this year. So again, testing on our recent all-time highs. But I still believe that we're somewhere between now and then. I wouldn't be surprised if we have an 8 or 10% correction in the market as well, which I think is healthy. We need something like that, right?
Yep, absolutely. All right. Bill Gates says quantum may become useful within 5 years. Would this be a good time to jump into quantum stocks? Now, before you answer that, John, I just want to point out that's interesting that Bill Gates gives the 5-year time horizon, because a few months ago, NVIDIA CEO Jensen Huang gave a more pessimistic timeline of 20 to 30 years, John. So it's a matter of, okay, which one of these guys do you believe?
And then Microsoft, I think, came out and said that they have a new quantum chip, right? That they said that they're starting to use. So here's some of the quantum companies. Again, I think a lot of these have got a lot of frothiness to them. If you look at them in terms of their 52-week gains, a lot of big gains in here. Again, we talked about the Defiance Quantum ETF, where you get a mixed bag of all these. Even like somebody like IBM, who is on the leading edge, of quantum technology. And again, this is kind of an old school blue chip stock. I mean, it still is up 43% from last year. So are there opportunities in here? I do believe there are opportunities. The question is the applications, right? How are these companies going to make monies with quantum computing? And I think that's the unknown, but it's certainly fascinating. I mean, I don't know if you understand what I know. I barely understand, but basically you're making a computer not with bits, which, binary bits like what normal computers are, that are literally using atoms, or at least the electrons that are in the atoms, to basically solve equations, which is just Star Trek mind-blowing, right?
Absolutely. All right, John. So let's finish off with one final question, and it's your favorite topic, and that's Bitcoin.
Oh, yes.
So the
Actually,
question
I've been
is,
watching this. I've been curious to see where you stand on this one.
You've been chomping at the bit to talk about Bitcoin, John, I think.
Oh, for weeks now. Yeah. What do you think? I mean, it's been kind of sideways. It's not really doing anything, and you got your big movement. You didn't get your altcoin, or what you did get a little bit of an altcoin movement, but that quickly faded.
Yeah. So, I mean, I think, the question was that Bitcoin's been holding up relatively well. I mean, and it has. I mean, this is a sideways chop consolidation period. I mean, from November through the current period, it's basically where it was, 3 months ago, more than 3
Right.
months ago. So I'm okay with this. I think it's building. I think it's building another base, and I think it's gearing up for the next leg higher. So the final question on that submission was, am I bullish on Bitcoin? I am. Yeah, I've not sold my position. I've not deviated from anything regarding
Right.
Bitcoin. So I'm good with it.
I know my year-end target, I gave a binary answer. I thought this Bitcoin would either be at 125 or 75. And so you can kind of see where 75 here is. And if you measure kind of like this width of this channel or whatever, this sideways action between, what is this, about 90 on the top and 105 on the bottom, 110. So if you break out of that, it's another 15,000. So that puts us around 125. So, I think it's a 50-50 coin flip, but sounds like a lot of adoption. I hear a lot of adoptions, a lot of central banks, a lot of people are right. The interesting that I think that I saw, Thomas, and that, I know we want to finish up here, was I saw today that the CME is going to start offering options on Bitcoin ETFs. That could be a game changer. That might actually create more of a buffer, or in other words, take the volatility out of Bitcoin. So which I think is actually a good thing for Bitcoin investors.
Yeah, and I'll end on this note. The one thing we haven't seen yet for crypto as a group is quantitative easing from the Fed. So I've pointed out that we kind of need that QE to return, John, before we get that sort of final parabolic move that we've seen in past crypto cycles. So keep your eyes on that. No, absolutely nobody knows when that's going to come, John. I mean,
I'm going to tell you, it's not happening this year. I can guarantee that one.
Well, I guess we'll be holding on to our Bitcoin for a while. So, all right.
All right, buddy.
John, that is going to do it for today's show. Quick reminder, guys, John is traveling next week. So we're going to be off for next Friday, returning the following week.
I'm sorry about that, folks. Yeah, I'm going to be spending a little time with my granddaughter. I promised to take her skiing. So I'm going to be doing that next week. But we'll be back in March, and trust me, we're going to be on top of the market. We're looking for some great opportunities. So next time, best of health, manage your risk, and the good of all trading.